Gold managed to snap its two-week losing streak last week, rebounding higher to the 1,850 level, despite a relative stabilization of the greenback and hawkish calls from various Fed officials that reinforce the view that the US Central Bank will need to press on with the restrictive monetary tightening efforts to combat persistent inflationary pressures. In this report, we aim to shed light on the catalyst driving the precious metals price, assess its future outlook, and conclude with a technical analysis. Today, Tuesday the 7th of March, and tomorrow, Wednesday the 8th, market participants will shift their attention towards Fed Chair Powell's speeches at the Senate Banking Committee and House of Financial Services Committee, respectively, seeking for clues as to how high the bank will raise rates to tackle the inflationary problem. The head of the Federal Reserve would testify at the hearing of the central bank's semi-annual monetary policy report, and according to a WSJ article, Powell will likely be asked by lawmakers if a half percentage point move is under consideration. Currently, according to the latest FFF, the market assigns a 77% probability to the scenario where the central bank proceeds with a 25 basis point rate hike in the March meeting. Should the chairman signal that a 50 basis point hike is a possibility and delivers his message with a hawkish resolve, that will force the market to readjust its stance. Hence, we may see the dollar receive inflows, which might in turn cause the pressures to relent some of its recent gains. The prospects of tighter financial conditions from the Fed dampened the appeal of the shiny metal in the eyes of investors. Throughout last week, several FOMC policymakers expressed their views on how the bank should proceed going forward. Taking into account the latest round of economic data, San Francisco Fed President Daly over the weekend commented, "Restoring price stability is our mandate, and it is what the American people expect." So the FOMC remains resolute in achieving this goal, adopting a hawkish stance, siding with a more aggressive response as the latest PCE data pointed out that inflation is not subsiding as quickly as one hoped. Minneapolis Fed President Kashkari stated that he remains open-minded and prefers over-tightening rather than under-tightening when it comes to monetary policy actions. Fed Governor Waller pointed out the resilient employment market, strong consumer spending tendencies, and hotter than anticipated inflation is not reflecting moderation or evidence for a cooling economy, stating, "We cannot risk the revival of inflation signaling that more must be done." This Friday, the market will be forced to grapple with the latest employment results for the month of February, following last month's blowout report that drove traders to downsize their over-optimistic speculative bets for a less hawkish Fed, which yielded a significant inflows towards the greenback and tarnished the pressures. According to forecasts, the market expects the non-farm payrolls figure to ease to 200K this month, following the incredible 517K newly created jobs in the month of January. Should the actual figure match the expectation, we may see the dollar coming under pressure and, in contrast, see gold receive support. Worth pointing out, nonetheless, is that the 200K employment figure expectation falls in line with historical averages, implying that the US labor market remains robust and showcases its ability to stand strong amidst a high interest rate environment. Turning our attention towards the unemployment rate expectation, the market consensus sees the rate holding steady at 3.4%, near record lows, which validates the view for a resilient US employment force. In regards to the year-on-year average hourly earnings rate, the market forecasts an acceleration of the rate to the 4.7% from the 4.4% of the prior month, and should the actual rate meet the expectation, that would practically reaffirm that inflationary pressures pose a systemic risk in the US economy, providing therefore support for the dollar and placing pressure on the shiny metal. Overall, the results are expected to provide support in the Fed's case for pressing on with more rate hikes, since the employment market has yet to show any cracks, allowing the central bank to focus solely at keeping the inflationary monster suppressed and under control, this allowing it from becoming deeply entrenched in the US economy. Should we see the NFP figure exceed expectation, that will reinforce the view for a hawkish policy response from the Fed and hurt the pressures, since the prospects for tighter financial conditions dampen the appeal of the shiny metal. On the contrary, should the NFP figure fail to live up to the expectation, we may see the bullion glisten in the eyes of investors. Thank you for watching.